Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our list of 72 favourite funds, namely Vanguard FTSE Japan ETF. This is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the ETF is tracking the FTSE Japan Index. This covers large and mid-cap Japanese stocks that are themselves members of the FTSE All World Index. The ETF uses physical replication to provide performance. This means it owns the actual underlying stocks. And as I sit here, there are 493 companies in the portfolio. The top 10 holdings represent just under 18% of the assets under management, so any investor buying this will get diversified exposure to the Japanese stock market. The largest individual stock positions are car maker Toyota, Mitsubishi UFJ Financial, technology to telecoms group SoftBank, Sumitomo Mitsui Financial, and another auto stock, Honda. This first chart shows the £830 million portfolio's weightings by sector. Industrials, consumer discretionary and tech are the three biggest exposures at 19%, 18% and 14% of total assets respectively. By contrast, energy, utilities and real estate have a combined presence of barely 8%. Dividends are paid quarterly and the historic yield's around 1.6% based on the 36p of dividends paid over the past 12 months and a price for the ETF just north of £22. The ongoing charge figure is just 0.19%, a figure beaten by just 2 of 37 rival products. So Vanguard FTSE Japan ETF does look pretty cost competitive. It's just over 4 years old and comes with a 4-star ranking from Morningstar for those who put value in such things. As a final point, the ETF comes with both sterling and dollar price versions. We're talking about the one that's denominated in pounds on this occasion. So those are the mechanics. The next question is, why would an investor consider this ETF for their portfolio today? And I think there are 3 factors to consider. The first, well, is that Japanese stocks are doing pretty well. The Nikkei 225 index is back flirting with the 20,000 mark it last reached in summer 2015, while the broader Topics index is trading near 1600, again, pretty much a 2-year high as we can see here. Those figures mean that the Vanguard FTSE Japan ETF has done well since inception too, as this next graphic will show us. The second reason for thinking about this ETF is that Japan has just recorded its 6th straight quarter of GDP growth, the best run in a decade. This does suggest that Prime Minister Shinzo Abe's programme of economic, political and social reforms, known loosely as Abenomics, is working, ironically at a time when Mr Abe's popularity with the voters is sagging to the lowest level seen since he took power in late 2012. The third reason, well, that's that Japanese companies, encouraged by Abenomics, are becoming more shareholder aware. They're increasing dividends, launching share buybacks and focusing on bolstering profits and return on equity. With 493 holdings and a low ongoing charge figure, Vanguard FTSE Japan ETF provides cost-effective and nicely diversified exposure to those 3 themes. But this is not to say the product is suitable for everyone, because there are 3 risks and possible downsides that must be taken into account. First, that 1.6% yield just may not be enough for income seekers. Second, the Bank of Japan is running a huge quantitative easing programme, running at 80 trillion yen a year, or around £560 billion a year. Remember, the UK's total QE scheme over the last decade has come to £445 billion. And the Bank of Japan's not just buying bonds either, it's buying ETFs like this one. So skeptics will want to know why you should buy a market where the central bank's been the single biggest buyer of stocks in 2016, and where the central bank owns 3/4 of the total assets in Japanese ETFs, according to research from Societe Generale. Surely the questions are, what happens if the Bank of Japan stops QE and stops buying, or even tries to unwind it and start selling? The third issue to think about in terms of economics is, well, it's just Japan is where no one wants to go. It's run QE and low or zero interest rate policies to match those of the UK, US and Europe for the last 20 years on and off, as it's fought deflation, weak demographics and government debts that come to around 240% of GDP, the highest figure in the world as we can see here. Bears of Japan will therefore argue the company is simply a debt-riddled basket case, destined to suffer poor growth unless the social reforms go even further and taboo subjects like immigration are tackled to help compensate for the low birth rate. So when you do your research, it's therefore important to make sure that Vanguard FTSE Japan ETF fits your own personal overall investment strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.